The following presentation is brought to you as a courtesy from Forex Academy. This is part of our service, Live Beginner's Course. If you find it interesting and wish to be updated on new releases, please subscribe to our YouTube channel or join our community at forex.academy and receive all our services for free. Your like is also highly appreciated. Enjoy.
So we've done a lot of fundamental discussion there in terms of the market structure, and we've understood that they're all inextricably linked in some way or another, and you can see how the different perceptions of risk relate to different asset classes. What about a technical market structure? Does that exist as well? Well, we can of course ask the question, first of all, what is technical analysis? And we'll go through a little discussion to answer that question. What is technical analysis? Of course, well, it's the study of historical price action with the objective of making profit from future price speculation. The aim is to develop a methodology for forecasting the direction of prices via past market data. A technical analyst gauges the commitment of recent price transaction from all market participants to assess future movement. We can trade this form of technical analysis as standalone. Okay, so that simply means, well, we're technical traders. We don't have to take in all the fundamental analysis, and we simply trade the prices standalone. Assists with trade selection, entries, exit, and risk management. And we use, of course, Japanese candlesticks for interpretation. So you can see where we're going with this in terms of trading the market structure. We can know that, well, if we use our insight to technical trading, it results in greater objectivity when performed reactively. So all we look to do is reactively, we're reacting to the market as it moves each particular day in terms of assessing the commitment of traders and our technical analysis. So that would lead us to believe, well, there is a technical market structure performing then, of course. That brings us in then to going through some of these structures in terms of technical support and resistance, perhaps, and other different various features of technical market structure. In terms of technical support and resistance, we identify genuine levels of support and resistance, which will help the trader discover floors and ceilings in the market. Okay, prices are often supported by the floors and resisted by the ceilings. These levels are particularly important for over long time periods. Okay, so if you're trading 5-minute price charts, of course, they can hold some weight, but if you see a very well structured support and resistance level, a daily price action, well, you know it holds long weight, and there are many other observations or traders who are observing and trading these levels. However, they're never a sure signal. Prices often break through such levels price often breaks through such levels with strength, so a breakout. It's often the breakout trade we like to try and anticipate in the markets. Common question we have is, where exactly should support and resistance levels be placed? Okay, so this is a common question we get, of course, from our beginner traders. Well, I know what it means. I have a rough idea of where to place a level of resistance in the market, but where exactly, what price do I place it at? Well, this is a gold market, and again, totally hypothetical. We can look across the market again just to observe some of these levels in the market. Okay. Now, there's no right or wrong answer. That's really the case in terms of applying your technical analysis here. You use a certain level of discretion. How do I identify genuine levels of support and resistance? Well, you'll be looking to insert them due to the recent highs and lows in the markets. You're looking for previous highs and lows that have discussed or reflected to inflection points where the market perhaps has reversed. Excuse me, where the market has reversed from certain levels where it has looked to hold weight in terms of not being able to break through, whether it's been a level of support holding the market or a ceiling in the market where the market has traded up to the level and simply cannot look to break it. So just as we look across this chart as well, you can see already we have what we would call a high level of support here in terms of just holding the market. Then what happens when the market trades up again? Well, it's trying to break through, but it's being resisted. There's a very well-defined ceiling in this market, and the market trades to the downside again, creating a very technical market structure in this gold market. So again, here's the German DAX support and resistance. What we're really seeing in this market, well, the ceiling provides resistance here, and as the market continues to trade, well, it does the exact opposite. So effectively, we see the ceiling reverse, then our floor here is providing resistance again, support, excuse me. Then we get the market trading to the upside as well. It effectively breaks, but just breaks it above and starts to close above it. 1, 2, 3, 4, 5, 6 candles, a full week of price action above it. That becomes the new floor. You can see it's very well conformed, and again creates the full level of support and resistance, just as so effectively becomes a new floor in the market. And that's very important to notice. These market structures actually reoccur in the markets. This ceiling effectively provides a floor, becomes a floor in the market. Okay, so once that level is broken down, it still holds weight in its level of technical significance or technical market structure. Then what happens with more relative price action? Of course, we get the inevitable break of a very strong candlestick break again right here, and the question is, well, is this going to be our new floor in the market, given it was a previous level of technical market significance? Okay, so that's effectively the trading opportunity with the breakout, and the technical weighting of these market structures is very visible. Fibonacci, I don't know if you would have heard of this before. As we go through many of the education, you will hear many traders discuss their Fibonacci retracement levels. It's something that we can look at in terms of identifying technical market structures. It is simply based off the sequence of numbers developed by Italian mathematician Leonardo of Pisa. The sequence of numbers range from 1 the way up to 144 in a very significant golden circle rule. Both mathematicians and scientists conclude the Fibonacci number sequence are expressed in many natural universal proportions. So we have sunflowers, we have shells, we have the pyramids there. The Giza pyramid, of course, in Egypt was built on the golden number rule. Many universal proportions indeed. And we use this in trading as well. There are important to us as traders. They can identify possible levels of support and resistance in the market. Traders often range trade these levels or look for breakout opportunities. An acknowledgement of such levels often causes trading congestion or congregation around key Fibonacci levels. Okay, so this is how we use them in terms of trading. This is the gold market again in priced. You can see it's trading from left to right. A long-term pricing trend. We're looking at daily price action here. Fibonacci retracement is placed from recent high from low. So basically what we'll do with this Fibonacci is pick a point in time. I'll just annotate this on the chart for you guys. This is our swing high, and this is our swing low at this price. We'll drag this the whole way up, this indicator to swing high and swing low from this point in time. That creates our Fibonacci indicator across our market. And as the market trades, you can see that there's lines across the screen, guys. That indicates to us that these are our technical support and resistance levels. Okay, our 61.8, our 50% retracement level, 38.2, 23.6, and again a full retracement back to our 0 point. So very, very significant. As technical traders, it works better for certain asset classes. What we're looking to define is how the market trades at this level. If it pulls back, is it going to sit at this level in terms of a floor? Is it going to have the breakout opportunity to the downside or upside through the levels? Again, this is how we look to trade our indicator. So the question I would like to pose for us here, guys, is, well, what happens next? What happens next with this indicator? Effectively, the market trades from left to right. You can see how significant it was. So if I just actually play with this for a while, scroll back, you can see we're trading the same gold chart. Our indicators are significant at 50, 38.2, 61.8, and the chart moves on. What you can see is it's very conformative again in so many levels to the actual indicator itself. We see it bounces to and fro from the indicator. It retraces the whole way back up to our 0 point at one time. This huge move retraces the whole way back to the 0, and This is the high. This is the all-time high. Well, most relative all-time highs from these levels again. You can see how conformative that is, guys, to actually reversing from our 1363 level. Okay, so crazy significance there in terms of following this price action. Again, leading us to believe that there is such a thing, of course, as technical market structure. You can see points when it effectively breaks through, so the breakout trade is on from the technical level. And again, the hypothetical question is, well, what will happen here? If this market is strong, we're more likely to get this level right here providing a support as a floor, and then we get price action trading in between these levels. That may be the case. So that's the point in terms of defining this technical market structure. It's the awareness of Fibonacci levels that markets often focus. This can become a self-fulfilling prophecy as traders observe price action around these levels. So the fact that many traders are actually observing this technical market structure, they know that there's going to be a level of concentration, price congregation in and around these levels, and then prices will shift away. Those are the trades to look for. In terms of technical price charting, it exists just as well. Now, before we just try and describe it hypothetically, let's jump in, and this time let's observe the price charting first. Can you spot the effect of price consolidation in the markets? Again, I've chosen a different asset class, again, than the currency or forex pair or the gold market. We're choosing the oil market here. Something completely uncorrelated, but again, you can see there's a very significant level of price consolidation. Once we get the breakout to the upside, well, we see the 54.50 level and the $52 level is very conformative to an overall price consolidation level. So the market trades in here for a period of roughly 3 months within such a level, provides us with great range trading opportunities as well. From 1, 2, 3, 4, we get three to four very good trades to the upside. And evidently, we get the breakout to the downside. Okay, we get the breakout to the downside in candlestick number 4. I'll just scroll back there, and then effectively, once the price consolidation is broken down, well, the technical market structure is broken. So then we get the overall downtrend to the downside. That is the opportunity. That is the breakout trade. Why? Not only because the market's broken on the 4th candle and the candlestick is quite significant, perhaps something fundamental happened that day, but the fact that the technical market structure of price consolidation here broke down. Okay, and once technical markets fail, and we'll discuss market structure failure as well in this lesson, then it's more significant to us in terms of the trade. So here we have the overall level. Again, this is just the same chart. As the price action continues to move, we see it comes back. It literally trades down, then it turns around and trades to the upside again into our new levels, and then reverses. Now, what is likely to happen? Well, we've had a breakout. We've had a breakdown of the technical market structure. What is likely to happen? Well, it's going to trade and it's going to create its new market structure, which is in the form of a channel to the downside. So you can see that again, we've effectively had the break to the downside, we've had the move, the market has retraced, and again, this is our new level. So again, if we get the market reversing off this level, coming back up, we might get a bounce off this level to look to trade it to the downside again. So very, very keen technical market structures again across these asset classes, and again, that's effectively what we're seeing. So price consolidation relates to price congestion in the marketplace. Consolidation is often around well-identified levels in the market. It often creates order stuffing at institutional trading and range trading in retail trading. So order stuffing, what is that really? When we see the market trade that range for a long period of time, well, we're simply trading the range. Retail traders do this as well, but institutional traders, given they trade on the trading ladder platforms, they will stuff the markets with orders to look like the market is weak or strong at such levels. So creating that level of market structure as well at an institutional level. The longer the price consolidates, the higher probability of a breakout opportunity. And inevitably we have the stop loss effect when all those order stuffing is in place and the market has the breakout trade. well, all those guys that were long, all of those traders, market participants that were long those levels will have to effectively get out of those trades. So when you're long, you have to effectively sell the market to get out, causing a real stop loss effect, a real shoot to the downside, of course, causing the breakout trade. And it provides, of course, many different effective trading opportunities both during and after, so we can trade the trade range. When that market structure, the technical market structure, breaks down, we can look to trade the breakout as well. Again, another form of technical market structure is a price channel. Simply put, it's when the market trends to one simple direction, but of course, markets do not trade, they're not simply linear. They trade up and down given volatility occurs on a daily basis. They give us notable structures within the market here. So this is simply what we call a price trend or a price channel to the upside. And you can see we have a very conformative one here. You can get some very good buy trades to the upside. Then when it breaks down, of course, at our level here, you can see it breaking down. We get a new, so we get a break of a market structure. We get a new trend or a new price channel or a new technical market structure developing. Evidently, that's short-lived, albeit for perhaps a period of weeks. And then we get another very, very conformative, albeit we have an anomaly here with some volatility, price channel to the upside. Again, providing some very good signals there to follow that momentum. So very, very notable trends developing there in the S&P 500 daily price chart. Ascending triangles, what are they? Again, we're talking about market structure, technical market structures. We're talking about price consolidation. That is effectively, guys, this is the best way to actually see consolidation in the market. Why? Well, you can see price pressures pushing the market up to the upside. You can see it's being squeezed in terms of this is the high of the market. It's being squeezed in greater and greater to the actual level itself. We're getting consolidation. Then we often get the trade bursting to the upside if that is the case. So I believe we got that continuation there to the upside. Again, a very technical trade. We have bullish price congestion, resistance level at ceiling, ascending triangle formation, and you can see the ascending triangle is very vivid there just in the triangle market structure. So again, very, very significant in terms of squeezing in that price consolidation or congregation of trading. And a descending triangle again to the downside can be another market structure that you can look to identify trading opportunities. Is it of any significance that it's a descending triangle that we're looking at as opposed to ascending? Not really, because we've had inevitably the price experience a big downturn, okay, down to nominal levels. Then we get a lift, and then we get our descending triangle to the downside. So when the market touches these levels of support and resistance, 1, 2, 3, what is likely or what is the best technical trade that you're looking for? Simply with this right angle here to break this to the downside, okay? To really break this to the downside, that would be, of course, your trading breakout trade. That might not be the case. You might get more trades at these levels here, simply looking to bounce off such technical structures. So technical structures, when we discuss obviously price charting all of these together, in contrast to the technical indication to Fibonacci retracements, which was an indicator, price consolidation, price channels, and triangles can provide structural failures. Focus on observing the most recent price action in an attempt to understand what is happening in the price technically. Technical market structure, okay, what is happening in the price technically? So we observe and understand the interaction between buyers and sellers of prices. That's a given. We analyze the recent price action in relation to the trend. Absolutely. We attempt to enter the markets at the best possible time. So the best possible time, how can we do that? Again, we can, guys, simply bring this back to our technical analysis, the whole way back there to technical trading, or the discussion of the battlefield between buyers and sellers. We discussed the Japanese candlesticks. Okay, so how do we get the best signals? How do we look to enter the best trading opportunity? We advise ourselves in the best possible mode of applying our technical market structure ideas to our fundamental market structures in pricing assets. This is the cable market, otherwise known as the sterling or pound dollar market. So we simply look at the life of this trade, and we try and objectively look to assess its market structure. So what I'm going to do here, guys, is bring all this context into light, and I'm going to walk you through objectively analyzing this market and why we might look to trade this to the downside. What you're seeing on the chart right now is just simply the movement of price from left to right with daily price action. So let us walk through this trade and objectively think. I would believe many of us will have a very different opinion to this trade after we assess it. So the first thing is we have a bullish trend. It's very obvious. Bullish trend to the upside. We have an engulfing bullish candle there showing that this market's moving up. Then we have a rejection to the upside just within the candle, and the next day we get a rejection candle as well. So I'm just going to note this here significantly with my marker. Let's just call this candle 1 and 2 because they're very significant in terms of the rejection. One is quite bearish, one is a doji, albeit it's an inverted hammer doji. So that dragonfly doji is telling us that, of course, we have a rejection to the upside. Then the market continues to trade left from right. It trades to the downside again, and it actually creates a structural low. And it's right at that level, guys, right at that level. So the market is bearish here. It doesn't want to break it. Then it trades to the downside the next time. The low of that candlestick is effectively the open of this move before our number one engulfing candle. So that's quite significant that it just came down and reversed off this level. Okay, so we'll call that a rejection candlestick as well, but that's actually a rejection to the downside. So we're not sure what to do at this moment. The market then trades and closes at new highs just here within the middle of the range here. Trades up and again cannot break the level. Here again we see actually trading to the upside, and again this is a rejection from that level from yesterday's close there to the downside here. So that is quite significant technically for us. There the confirmation we're looking is in the next candlestick structure, guys. How is that created? Well, let's just move on through the candlestick again with failure to break and close on new highs. Retraces the range from early engulfing candle and closes below the level of confirmation. Very significant for us. Here is our engulfing one. That is now invalid because we get the close trading below here again, retracing the engulfing candle and closing, guys. The close is on the low of the day below our structural low. The next candle as well is quite significant. It tries to trade up. The high is just above the level but gets rejected, albeit it's slightly bullish on the day. It does trade a lot lower, and then we know that this market the next day is considerably bearish because it has tried to trade up again, rejected, and is trading to the lows again. We're getting continued signs that this market will not trade. So this is the trade, of course, and objectively we can say, guys, this is of course time to sell this market. So I just walked you through the life of that trade. You can see how it's just looking at the technical market structure, guys. This is stuff that we've actually all learned in in the first few lessons of the beginner's course that you can actually apply yourself. Okay. And again, to bring all this into context, we need to, and I'll just go back to discussing the importance of patience in this trend. Obviously, there is a trend to the upside. You need to be brave enough just to say, well, this trend is reversing and pick a point in time. What you need to do is apply your technical analysis, be patient, look at the market structure, again, follow this trend, see how it trades, and of course, this is effectively the high 142 is the high of this move in pound sterling. Sterling dollar. So be patient, guys. We know that we implement some early technical analysis is important to realize that as a technical trader, we aim to stack the odds in our favor. So we're all about trading probabilities. We aim to stack the odds in our favor. Identifying one technical signal is never enough to make a sound trading decision. Successful trading requires patience. What will this do? Well, it will increase the quality of your trading. Patience will allow time to assess how your technical trading ideas with the fundamental environment stands up. So again, if you have an idea of a market fundamentally. Let's pick a market in question. Let's pick the gold market, and we say, well, the dollar is very, very strong at the moment. That's going to lead us with the negative correlation that we know that exists between those two assets. That's going to lead us to believe that there's going to be a sharp move to the downside over the next 3 weeks in the gold market. That's just a fundamental idea, however. What we need to look is our technical analysis to see if we have a level of support or resistance that we can break, where gold is trading exactly at the moment, how the technical market structure is supplementing our trading idea with the fundamental market structure as well. Patience will mean that you won't miss the best trading opportunities that arise in markets. Okay, so perhaps sometimes you can be too patient. That's okay, but you're not going to catch every single trading opportunity. But it will allow you to capture the best ones that present themselves, because you won't be in other trades that you'll be confused. You'll be diverting your focus elsewhere. You'll be assessing perhaps that trade that I suggested in the gold market and saying, well, this is the technical structure that I'm waiting for this structure to break down. When it does, I know there's going to be a big move in one particular direction. Again, subjectively use all your analysis to cement your trading decisions. Patience will prevent overtrading. And again, when you're being patient, you're of course not overtrading. The idea is, of course, that you're going to have more of a qualitative approach. And when you make 10 trades over the course of, say, a week, and they're all sound technically, as opposed to making 100 trades over the course of the week, well, who's going to have the more idealistic stacking the odds in your favor in terms of stacking the probability in your favor approach? It's of course the guy who has more patience, trading less and trying to pick the higher qualitative trades. So that brings us to the end of our webinar number 5, discussing building the trading toolkit with market structure and really getting into the idea of technical analysis 101. What did we learn? Well, that markets are all inextricably linked. Now, this does not simply mean that fundamentally they're all inextricably linked in terms of capital trade flow and correlation. It means that, well, markets have technical market structures as well, and we can perceive them in markets. We can look at technical support and resistance. We can look at Fibonacci retracements, consolidations, trends as well. All of these market structures to help us with our trading. Okay, and now we're starting to become a little more of a technical analyst as well as understanding price action. So it's great to see how all this combines together, and that you're starting to develop your own skills yourself as a trader. So what we learn then, of course, moving on to tomorrow's webinar, same time, of course, here at Forex.Academy, we have protecting capital and risk management. Very, very important indeed to survive in these markets and to protect your capital at all times. We'll be looking at probability in trading, protecting yourself in the markets, and defining risk to your own level of risk assumption. Okay, so well done, congratulations. We've now went through the whole lesson there, a really enjoyable lesson on market structure. Finished webinar 5 of the beginners trading course. I hope you're getting a little more knowledge in terms of you're feeling you're learning a lot throughout this course, of course. Look, what I'll do is let you go for the rest of the day. Do enjoy your day. Good luck in the markets, of course, as always. Thank you very much for joining us here at Forex.Academy. We'll see you next time. Bye for now.